guys for reading through those disclosures. As I said, my name is Natalie Beckett, and I will be your moderator this afternoon for another one of our free educational webinars. This afternoon, we are happy to have Bubba Horwitz back with us. He is going to be discussing part-time day trading futures. And to introduce Bubba, we have Andy Aronson. He's team over here at AGT. Andy, are you with us?
I sure am, Natalie. Can you hear me?
Yes, I can. Nice to have you here. Why don't we go ahead and introduce the man himself?
Sure. Bubba, are you with us today?
No.
Well, got you 2 days in a row, so we really appreciate you coming out. We got a pretty good crowd today, so I'm sure we're going to have questions. And if you're going to go through and introduce yourself as far as if there is anything in this world that you won't trade. So you traded, we did a web today about closing out an option position with stock, and today we're going to talk about futures. So you know all, and I think Natalie switched you to share your screen.
Oh, I can. Look at that.
Good to go.
The marvel of modern technology.
Yeah, all right, real quick. Those of you who have questions during the presentation, please put them in the Q&A box, and Andy and I will do our best to get those answered for you.
You took the words out of my mouth, Natalie. I was going to say, send your questions along, and I'll interrupt Bubba when I can and get those questions answered. So without further ado, Bubba, it's the stage is yours.
The stage mine. What's up, everybody? Welcome aboard, and nice to see so many gluttons for punishment who came 2 days in a row. So that's always a good thing. Anyway, so we're going to talk about part-time day trading because in my mind, the world of regular day trading is really not there anymore. There's not enough action, not enough business, but there's plenty of things to do. If you do it as a part-timer, and I think that's the best way to go. And so anyways, I have to also show you this risk disclosure. It involves risk and you can read it for about 3 seconds, and I'm going to move on because you already had a bunch from our friend Natalie. And for those of you who know me or don't know me, I'm not for all this, but I've been doing it for 38 years. I think that's what I've written a couple of books on it, and I still trade. And if you're trading at night, I'll trade at night too. So it's fun to do, and it's something that I really enjoy, and I love to pass on the information. So of course, I do it in media. If you saw me, I was on this morning at 4:30 on Fox, talking about oil and why it wasn't going down. So anyways, today we're going to talk about the skill of trading, why futures are the best, what are futures versus options, the advantages, what you know, trade type, strategy, product, skills, what to do, and how you can take advantage now. Meantime, trade itself, all trading are skill. Okay, not luck that makes get lots of money or lots of money or whatever. It's skill of trading. It's the understanding of the actual model of trading, and that goes for everything, whether it be stocks, options, bonds, commodities. You can wait and use the skill that you have learned in any sort of a mathematical game that you might have ever played. And of course, if you're a good poker player or a good backgammon player or a gin or bridge player, then you're going to find trading should be fairly easy because it takes the same distance. Because even if you have pocket rockets, if you have aces, they're guaranteed to win. But if you do have the advantage, and all you're trying to do when you're trading is to create an advantage for yourself, and that's what we're going to teach you, how to take an advantage for yourself. It is the best option for active or passive traders. The thing is, futures move in tandem with underlying asset. There is no funny. There's no premium. There's volatility, but there's no implied volatility. So they move directly in tandem with the underlying. So if you're trading the middle future, it's going to trade directly with the Dow cash. If you trade the P future, it's going to trade directly with the S&P cash. So again, you're getting something that's going to move in tandem together. There is no fun business going on. It's got to trade to the cash. That's the way it works. Future, no restrictions on short selling. Now, what's the advantage of that? Well, you don't have to wait. In the old days in stocks, you had to wait for an uptick. Sometimes they restrict it. Sometimes you can't short sell because they tell you they give you the old BS. It's hard to borrow. Future, none of that. Okay. Fit trading rules, they don't apply. Okay. So, you all have experienced the misery of not having a $25,000 account and trade and trading and then getting suspended or getting stop trading for a while. You go to the penalty box. That apply in futures. All right. You can trade one traded 14 contracts. Okay. So there's nothing that you have to worry about. They can make use lower initial margins. And that's one big thing that's an advantage as well in the futures market is that you can trade with brokers sure that worth I'll give you the perspective. One mini S&P is 140,000 approximately, which is the same equivalent of 500 shares of the SPY. However, to the 500 shares of the SPY, you need at least 50,000 margin to trade versus $1,000 or less to trade one mini S&P. So you get a tremendous margin advantage as well as everything else. The futures are very similar to options. They're a financial contract. The difference is the seller, you're both obligated to either buy or sell. Now, obviously, you can trade them, so you don't have to hold them to expiration, but there's no early exercise because you own the underlying. You own the big ticket. Now, you don't carry positions overnight when we're learning how to part-time day trade. Not a positioning system. This is a model that you trade during the day when you have time, and that's it. You don't have to make special time. The idea of the whole model of what we want you to be able to do is you've got to kill, you can go 1 hour. If trade doesn't appear, you don't make a trade. Okay? But really ours are just a contractual agreement, but that really doesn't mean much because you're trading in and out of them anyways. Now, future options, is the piece of all trading. You can have a limit your risk, but of course, if you limit your risk, you have to pay for that right to limit your risk. And if you've seen the volatility explode lately, well, that makes the cost of trading them a little bit more expensive. Now, I like to trade options as well, and don't get me wrong there, because again, if I want to set a position on that I limit my exposure, I can do that. If you're trading futures overnight, the Monday night they were down limit before closing up 700. But who's going to take that kind of pain on either market? So that's where options come into play. You've got risk, where in options the risk is to one party. If you bought and sold in the derivatives market, and of course, we only trade in markets that are exchange regulated. Okay, we not trade in forward markets. We do not trade in unregulated exchanges because if you do, you're looking to get a beat down. And a reminder, those of you who might have been involved in Forex during the Swiss franc debacle, when those exchanges or all those brokers went bust, they didn't have responsibility. Trade at the Chicago Mercantile Exchange or the Options Exchange or any of those exchanges, your money guaranteed. You're going to get your money. Even if somebody goes broke, you're going to get paid. It's important to understand all the things that go on because, again, you go to a market that's not regular, not governed, and of course, what happens is they go broke and they say, sorry, you lost your money. The advantage of futures, our markets are extremely efficient. They trade narrow bid-ask spreads most of the time. Tick sizes will vary depending on what you're trading, but they trade 1-1. So if you looked at a market, and I'm going to throw one up here for you real quick just so you get a feel for what I'm talking about. The S&P, you can see the market here. It's trading fast, but it's 8.25 to 68.5. Okay, that's all $1.50 tick. That's the bid offer. So you're giving up no edge. Okay, again, not like it's a wide spread and it's multiplied by X. It's straight. That's the numbers. So that's what you want to keep in mind when you're futures. You're trading a straight up market that is just purely trading. Lower commissions. Okay. Now the reason that they're lower commissions is because they're easier to trade, and there's not as many regulations around them. So you get a break on commissions, and you get to control a lot more, and you don't get stuck in a position that because you ran out of money, you got leveraged out, or whatever it happened, you don't get stuck. And of course, there's virtually 24-hour trading, but most of the time at night between let's say 6 Eastern when the markets reopen and midnight, they're probably liquid. Now again, if we continue with this volatility and we get a sell-off, then they will become liquid and you can't trade them. Now I watch them myself. When I'm around, I'm always watching them. Okay, but sometimes they're tradable, sometimes they're not. I wouldn't plan my day around trading futures at night. Okay, However, if you want to get up at 1 o'clock in the morning and trade the DAX, do that. That's very liquid at that time. That's when it opens. If you want to get up at 4 o'clock in the morning or 3 o'clock in the morning and trade the FTSE, you can do that. There's times when there's action overnight, but in our markets that we trade most of the time, I can count on them being very active. We also have the leverage part, which is the leverage is always a double-edged sword, because it's nice to be able to have a $5,000 account and trade an S&P, and it'll be over margined. Of course, if you trade many of them, then you're putting yourself in risk, especially in markets like we see today. The last 4 or 5 days have been extremely volatile and extremely whippy, and we've had major moves back and forth. That's good and bad. That's why you don't want to be you never want to over leverage. And I always just remind everybody, just to Bear Stearns and Lehman Brothers, and the reasons that they both went bust was because they're over leveraged. There's no pattern day trader rule. There's plenty of liquidity as long as you pick liquid future to trade. If you trade frozen concentrated orange juice, not very liquid. But the main products, all the financials, the S&P, all the equities, bonds, grains, then as liquid as can be. You can diversify. You can trade. What we're working on is trading any product. I don't personally care what the product is. I just look at the chart. Right? That tells me if it's tradable. It does not matter what. I'm going to trade everything the same because we actually believe in something which is called universal price. All the same, all patterns repeat themselves, and nothing matters. But what you are trading is directly correlated to the underlying value, so you have nothing to worry about there. Well, is you have to have knowledge, and it's not knowledge about what is earned or how does it trade. You just know, is it liquid and can I trade it? Okay, I mean, even a weather pit. Okay, now, we don't trade the weather, but you can trade anything. You have to understand the market, not necessarily the underlying product that you're trading, because from my point of view, news is already priced into all markets, and it doesn't matter. So even if there's going to be a big announcement, the markets are kind of signaling ahead of time what news may be. So you don't have to worry about it. Again, you're reacting to a certain pattern, not anything else. You have to be realistic about your trading. You're not going to come in with $5,000 and make $100,000 tomorrow. Okay, this is a grinding business. It's trying to make a little bit, and then as you grow your account, you grow trading size, and you are compounding that way. You're not compounding by stretching or reaching out with margin, right? And the actions are simple. Now, different trade types. I'll tell you which one we would use, but there's a basis trade, which I not use. There are trades which I do use personally, but not part of what we're doing here. There is, so any of you who have been through hedging class, you know that if you have a big enough portfolio, you can use the S&P as part of your hedge. There is swing trading, which I do, and some who follow my advisory do, but we are only interested today in day trades. Right? We do not carry positions because, again, the more you have on, the more cash that is required and the more risk that you are. You remember, there's lunch, and nobody's passing out $100 bills on the street corner. So you have to make sure that you stay very protected and very safe in what you're doing, and that's why we restrict it to a simple day trade, and not only is it a simple day trade, but it's one type of trade. Now, there are strategies. Trend trading, we don't do. Okay. In swing trading, we might follow a trend, but again, not about that. There's the old gamble trade, which I don't recommend, because if you're going to gamble in the market, you're most of the time going to lose. But if you're with the itch that you got to gamble, there's better ways to do it than trying to do it with the futures market. Some traders which we don't chase momentum. There are trend trading, and then there's trade one specific pattern, which is what we do. We trade one specific pattern, and it a little bit the counter trending, but it is one pattern. That's all we're going to trade. About trading is it's always about numbers. The whole world revolves around the numbers. Now, you've heard me talk the government numbers. They're just trying to prove they know how to count, but we know that they can't because the numbers always have to get adjusted the next month. But when it's a pure trading, it's about the numbers. It's a straight-up number model that uses, if you have the Bollinger Bands, that's a mathematical indicator that uses 2 standard deviations up and down. That's usually pretty good in the market to be looking for a trade. Now, we don't use that, but we do use it to teach. We do use it to help you. But the base model comes back down to mathematical model. So every decision we make has nothing to do with personal opinion. It has nothing to do with what the guy says on TV. It has to do with the numbers. And it's always about the numbers. You're to build them. Okay, you've got to learn, you've got to practice more, and you got to learn again, and then you got to study. All right, now it's pretty basic, which it is. It's actually very simple. Not the trading that's hard. It's the your way that are hard, which is usually muted. So I'm singling anybody out. Your head. Okay, sometimes you get a little bit emotional, and I always remind you that you've ever said something to somebody out of a fit of emotion, and you take those words back. Well, if you do that in trading, you're going to wish you took that trade back because you're going to most likely going to lose. You have to be able to be very rote and very mechanical about the trading that you're going to do. That's how you're going to be successful. If you try to get outside the box, yes, you'll have winners, but often than not, you will never capitalize on the overall move because you're trying to cheat the system and cheat the numbers, and it just doesn't work that way. We trade that I view trade are interest rates, which are bonds, 10-year notes, and your bonds. They're thin, but gold's okay. Silver is a big. Silver, first of all, a big tick, and it's not a real. It's what enough. But I would never put anybody in the metals as they're just staying out. They're all very liquid, and in fact, in currencies they not only have mints, but they have micros now. That's a great place to practice. I'm not a big fan of practicing in a play account because they have the same meaning. Whereas trading a real money account, you win, lose, you get the real thrill of victory, or you get the agony of defeat. But these micros, you can trade them a little bit, and they'll give you some great practice for some real money, and their risk is very minimal in those. But it does give you the satisfaction of being right. Our trade, the only thing with grains is they are only basically open from 8:30 Chicago time, 9:30 Eastern to 2:15 Eastern. And gold, oil, very easy to trade, very good to trade. Stock index funds, obviously that's the equities. Stocks, I mean, they're okay. And then livestock is the best because it's only open from 8:30 to 2 and it's done. They don't have any overnight trading. Now, they have an effective system, which we do. Manage your risk. Again, I can personal experience that money be my risk at times. So just take it from me. You're managing your risk because the key to this game is to always be in the game. If you lose all your inventory, if you're not disciplined when it comes to trading of all kinds, but especially futures trading, then you're going to be in the toilet. Draw happen. There is no way, I don't care how good of a trader you are. There's no way that comes. Now, does it announce itself? Of course not. We never know when it's going to come. We know that it's going to come. And typically it will come when you expect it, when you're on a real roll and everything's going great and you really got to feel for it, and then you'll end up running into some bad luck and you'll end up with a drawdown. Now, the key is not the drawdown because we understand that. The key is understanding how to deal with it, and what you want to look for is if you're not trading, you've somehow got it up to 2, you've done really well, and you've now trading 2 at a time. Well, now you want to go back to 1 when you go into that drawdown period, and you'll recognize it because you'll feel it. To be very realistic about trading and about what you're trying to accomplish. What you must follow the trends. That's not really our gig in what we're going to do, but one of the ways that you always want to try to be with the trend if you're trading more longer term. No markets. Use any system and stick to it. Apply techniques to your trading. Do not overtrade. Just because you're watching does not mean you have to trade. Now, unfortunately, in today's world, I traded on the floor. At the trade, I'd just walk away, go play backgammon, or I'd go play gin. I was out the market. I wasn't watching. But in today's market, with the mouse right in my hand all day long, It's easy to click. Don't do that. It's not good for you. Markets with little capital. All right. I trade everybody up to 5 markets at a time, and not trade them all, but the more you can look at, the more opportunities you are going to be able to create trades. Don't just trade contracts, trade liquid markets. Reward ratio, that's not important. We have a simple model that works. We don't need to establish those. We have a trading plan. Okay, that's the most important thing. You have to understand what you're trying to accomplish and what you're going to do. Say a good trade or a bad trade. To manage those trades, take your lumps when you have to. And what we'll do, it's going to be very robotic. The stuff is automatic. You have a decision to make. If you're making money, the exit out of that trade, one locked in a profit. For small losses. Don't, and I've seen this 1,000 times in years, especially in the agriculture community. Everybody wants to be a weatherman, so they're always trying to play the weather. Well, in the world, with so much technology and firms paying huge money to have news first, you beat the news. So don't think you heard it. By the time there's been 3 or 4 million people that already have it ahead of you. Learn this. I'm an advocate of going back and doing what we call a post-mortem on all your trades. All orders. Don't use markets to gamble. You want to gamble, go to a Rivers Casino or go to Las Vegas or go to anywhere. Just don't do it here. Now, the problem of the market is that a skill game. Again, we talk about it all the time. This whole model is a skill. It's the understanding of how to read the chart, read the market, and on the probability. Now, again, if we just look recently, back to Monday, all right, the flower. Now, you watch that, but in a day, there was an 8-minute period that the market ran up 1,200 points in 8 minutes. All right. Now, I'm not going to be in there, but the probability was something like that was going to happen when they were just simply throwing the baby out with the bathwater. It's like I wrote this, that it's most likely going to be what I call a rip-your-face-off rally on Tuesday, which was yesterday. I write people, I told them on my call Monday, I said, if we get a big down opening, then you buy it. Well, as it turns out, obviously nobody could really trade this because they weren't all trading futures yet, but the futures were down limit on Monday into Tuesday morning. So if you're up and you saw that, it's a time to buy, believe it or not. And of course, that they drowned from down 1,200 to up, I don't know, I think it was 1,000 or whatever it was yesterday. But you create your own edge in this business. There's no, okay, and emotional kind of person. Now, we used to have somebody working for us that every time he put on a trade, he would break out. He would need a tube of Clearasil. Like that. If you're going to be like that, then trading is not for you. You have to be able to take it and not puke. That's the whole key. That's what creates market bottoms, is when people get the pressure anymore. Trend, just about the numbers. It's all, if you think about the odds of anything happening, and again, I always like to ask the question. I can't see the answers here, but okay, the odds of a coin flip are 50-50. We all know that. But if it comes up 100 heads in a row on the first flip, what are the odds? The odds are 50 because they're all independent events. Every trade is an independent event. But putting the edge in your favor, then you're no longer 50-50. It's just like I'm being a coin, I'm a 50-50. It's every time. But if I guess the coin, I could be 100%, I could be 0. So you're keeping the edge in your favor. Now, you're a mathematician. I'm certainly not. You have to understand the process of what we're doing. Now, there's forwards we don't trade because forwards are not guaranteed. Trade future options, one no, leaps no, bad no, and swaps no, because those are not as guaranteed as everything else. But derivative means it's derived from another product, and you saw that if you saw the movie The Big Short, all those major swaps and those derivatives were derivatives on top of derivatives, which they emulate with these crooked, phony ETFs, which do not work. Now, different traders, again, it depends on what you're trying to do. Now, again, we're strictly focusing on our own edge. All right, don't have a competitive edge, don't compete. And trading is a competition. Right? At the end of the day, we have you're against somebody else. If you're selling, somebody's buying. So, okay, you want to be prepared to have mathematical edge within your favor. Now, when we look at one trade, would be the mini S&P. Now, this is $12.50. So from one tick to another one, I just showed you, is $12.50. $1 is $80. Okay, it's open from 6 Eastern until 14. It opens at 4:30, closes at 5, and then it reopens at 6 o'clock. They're all Eastern. All right, so 24 hours a day. It has contract months that trade, and the cycle is if you've ever heard of triple witching expiration, this part of it originally. Okay, the witching cycle was the cycle which is March, June, September, and December. And the reason they had all the volatility on those days was because everything expired at one time. The options, the futures, the currencies, and the bonds. Obviously, they've changed that, so there's not so much volatility anymore. What we're looking for is patterns. Okay, pattern that we're going to trade is what's called the blow-off pattern. The blow-off, I'll show you some that were live today that I actually traded, so I can actually talk about them. Blow-off pattern here, right here in wheat on the 3-month chart. Trade, we're using 4 minutes, 5. I mean, I use 4 because I don't like to be in the crowd with everybody else. So I add numbers because it doesn't matter. But a 4-minute chart, and so looking for a blow-off pattern. So what does a blow-off pattern consist of? It consists of volume and move, one way or the other. We don't care which way it is. The volume and direction. So looking here, okay, very choppy market. We get a blow to the upside. Okay, this is very close, and I would venture to say that many would never make this trade because they'd be afraid that it wasn't a big enough volume. But I'm going to look at it right now to show if it would indeed qualify for what we're looking. Go ahead.
But it's Andy. I just wanted to clarify. You always look at the 4-minute chart. Somebody was asking about that.
I use a 4, but I have guys that work with me that use a 5. In business, all it's the same. You just on a 1 minute, a 5 minute, a 2 minute, a 20 minute, 80 minute. It doesn't matter. The reason I use 4 is again, it's a lot of platforms don't even have 4-minute charts. Number 2, I want to have the opportunity to make a 4-minute chart. There's going to be 15 potential opportunities per hour. So if I have an hour to trade, I've got 15 potential opportunities that are going to allow me to get in that market. Okay.
But if you see the pattern on a day chart, would you still trade, or are you always looking at the 4-minute?
I'll trade. I mean, a daily chart. Now I won't know on a day until the day closes, so I'm not going to carry the position overnight. So I might sell it the next morning, or buy next morning if it's blowing off. I'm not going to carry it overnight. So it's a little bit different. And again, if you use the daily model, then you end up with not many trades. And the idea of what we're doing is to create as many potential trades that qualify as you can. Okay? So what we actually do, the actual model works this way. So here's 4 minutes, and of course, I did make this trade, and you saw him spike. Now, it didn't spike compared to what you see the big spikes here, but it was the volume was dropping, and all of a sudden, you got a volume spike, and you get another volume spike. It indicated it's a bluff. So now, what I do is, once I see that, what I do is I'm going to switch to the 1 chart. Right? Is the trigger chart. Okay. So not the 4. I've got a blow off on my 4-minute chart. So now first red bar, and because we're going down, this is the bluff bar on the 4. So the first red bar here. So I'm selling right here. Okay. And of course, obviously we know the result. The markets got clobbered from that point. And not all that easy, but that's exactly what happened there, because you can see that here's what we and we went down about 100 ticks or so. Okay, and well, in this case it was 20 points in the S&P, which is $1,000. In the meantime, okay, that was the edge, and that's what we were looking for. All right, we were able to capitalize on that trade, and all the individuals I can't give you at the moment because it would take too long to explain them all. But that is the simple version of doing, is looking for those opportunities that occur. And what I want to be able to do, and what our goal is for you to be able to do is this. Hold on 1 second. I just have to pull up a different screen from another. Okay. So what we're going to try to get you to be able to do is up. Okay. Now I've got 15 times 4 opportunities an hour. So I've got 60 opportunities an hour that it may or may not show up. All right. Watching here, crude and all the equity products. Well, it's Russell because it's not liquid enough for me yet since I came back to the board. But well, I can see things that are starting to happen. If you're ever watching during the day, start to see your wolf start to flicker, then you know there's action going on. But this is what we're looking at. Okay, and it's on my other computer to my right, and I just see it, and I'm only looking to see if the action is showing, because I've got time to read afterwards. And I'm watching for this pattern. And always, it's the same pattern, so it doesn't really matter what the symbol is. I could care less. That's another 4-minute chart of Dow, right? And the number of opportunities in here today. All we're looking for is the blow that'll give us opportunity to get in. And we use now. Right now, this is going to change, but before this recent period, average loss on a trade was about $8, and our profit was about 160. Okay, we were about a 2-to-1. But again, the key number was the $80 loss on a losing trade. That's something that actually I have a class tonight which I'm teaching that to show them how to change it, because the market volatility has now changed. So we're going to have to change that part of it. But that's the basic rules. And now this is a look at how the Bollinger Bands are. Now this is not. I don't know. This isn't not the greatest example. In fact, screw this. Hold on. Let's go back here. I watch I get kicked off at certain times. I have to make sure I'm running good.
Go ahead.
I know. I know what time I got. I just looked. I got about 15 minutes. About 10 minutes. I got it left, I think.
You have to put pressure on yourself.
Yeah. All right. Where am I going? I'll tell you. Bollinger Bands. Okay. All right. So here's the bands. You've got the upward, the mean, and the band. These are designed. These are 2 standard deviations apart away from the mean. You notice as markets get quiet, the model collapses. As bigger, it gets wider. Look at it now. Now you've got a 300-point range between the deviations down and of course means we have 300 points to the upside as well. All right, now those go in and out depending on volatility. But here, all right, this is a blow downside here. What helps many who first start this is to have the Bollinger Bands up. You know that mathematically it's a pretty good entry as well. Okay, so that if you get every other factor and then you get this involved, then you have maybe a potential better shot at it. And all we're trying to do is make sure we all understand how it works. And this is the best tool that ties into the blow pattern. Now the first is discipline. Discipline, you have no chance. Your drawdown is always in the future. The market is irrational far longer than you can remain solvent. Manage successfully, and the rest will take care of itself. Don't trade Forex unless you're the bank, because the bank takes the edge on both sides. As a primary method of risk management, beyond what you know and what you don't know, and don't trade. The people that have been through the class, just what they've said, you are right. The futures are whipping around. Watch a bit, looking for the right footprint. Then get in so far. NASDAQ and other profits. Again, these are not necessarily you're going to be your profits, but these are people that have been traded through the class. And I made, I think, on the Trump election, made enough to pay for it. A new car, he said. But here's what we look for. Okay, now here's this. This is from a student, and that's why I put this up here. If you see what he bought, the blow-off, sold up in here, short, and closed here. Okay, that's the side of a trade. Now, again, what does it mean? It means if you follow, learn, and you end the pattern, and you can control your other outside emotions, then you're going to be in great shape when it comes to trading this. Because again, when you look at the market, all are the same. All repeat themselves, whether I'm looking at a 4-minute or looking at a 5-minute or looking at a daily, they're all the same. Just the shorter the time frame, the more trades you can create for yourself, the more trade you can create for yourself, the more opportunity you have to trade. And indeed, the key to working with these futures is to have as many opportunities to trade, because we're looking at a long-term cap gain at about 6 minutes. If you're longer than 3 or 4 minutes, you're making a lot of money. And you learn how to manage that trade all the way through, because there are times I trade live every jobs number for all of my students. And the day we actually sold a future, among the things, but we sold the Dow future, and I didn't have to cover it all day because it gave me a reason to cover it. And of course, about 700, and something that, it's a trade that doesn't happen that often, but if you learn how to manage them, you get to carry a bit longer. And that is it. If you have any questions or you want some more information, all you have to do is just email me at bubba@trading.com, or I have a bad number there, but that's a bad number. My number is 847. If you go down 847-722-7800, and I'll take any of your questions now. Or Andy,